market is flashing its recession signal, and something that I want to talk about because it's all in the news. Everybody's talking about it. The yield curve inverted. So in this video, I quickly wanted to go over everything, all the important things. So what does that mean? What are bonds first and foremost? What is the yield curve inverting? What does that mean? Also, in the terms of what does this mean for a recession coming in the next couple months, in the next couple years? What is the likelihood of that happening? And so just going over first and foremost, what is a bond? And this, I just want this to be a quick little video just to go over the important things that you need to know. So the first thing is, what is a bond? The U.S. government raises money by taking loans. One way they do this is by issuing bonds. And so you have your treasury bonds, your government bonds, and they all have different maturities. But at the end of their maturity, you will have gotten back everything that you loaned plus interest. So taking this into account, I want to ask you a question. If you are loaning the government money, okay, there's no risk of a default or anything like that. They guarantee that you're going to get what you loaned and then also interest back. So taking this into account, you loan the government, let's say $1,000 for 2 years or $1,000 for 10 years. Which one is going to demand a higher yield? And the answer would be the 10 years, because you're locking in your money for a longer period of time. And so the 10-year, this is the natural state of things, that the 10-year is going to have a higher yield than the 2-year. Occasionally, though, it happens that the spread between the 2-year and the 10-year inverts, so that the 2-year treasury note has a higher yield than the 10-year treasury note. And basically what this means is that in times of economic instability or uncertainty, people will be going into safer investment choices, such as government bonds, which is guaranteed. So they'll go into the 10-year, and as people buy into the 10-year, the yield goes down. So the yield curve inverts such that the 2-year yield is higher than the 10-year yield. And so what is the importance of the yield curve inverting? And so over the past 40 years, every time the yield curve has inverted, a recession has followed. And so that's kind of one of the most reliable and predictable indicators of a recession coming, is that the yield curve inverts. And so just yesterday, the yield curve inverted, where the 10-year yield was higher than the 2-year yield was higher than the 10-year yield. And so that's kind of one of the things that people are looking out for, and it's kind of important to talk about. And so what I have to say to this is that the yield curve inverted, which is one of the most reliable predictors of a recession. And so some economists and analysts are coming out and saying that this indicator is not as important as it was in 2008, the last time that it inverted, and that we shouldn't be looking at this indicator as importantly as we did in the past. And so what I can and can't say, I can't say when there's going to be a recession. We are in the longest economic expansion ever. I don't know, this is normal like economic cycle, so I don't know when a recession is going to happen. There is going to be a recession. I cannot tell you when there's going to be a recession. But with this in mind, I can tell you that if you are a long-term investor, you are looking to the long term. So if you're a young person and you're a long-term investor, you're looking to the long term. So you shouldn't focus on these short-term moves, like what's going to happen in the next couple of years. You should be taking a look of what's going to happen in 20 plus years, 30 plus years. And so as of right now, you should be, if there's any concern and you have extra money, you should be dollar cost averaging into indexes and things like that, and setting yourself up for the long term, 20 plus, 30 plus years. And a lot of people that I'm speaking to now, including you, are younger people who, if you're a long-term investing, you should be looking to the long term. So 20 plus years, 30 plus years. You shouldn't be looking to these like short-term moves, because right now I can't tell you if a recession is going to come in the next couple of years. I'm not really concerned with that, because I'm looking 20 years out, 30 plus years out. As long as you keep dollar cost averaging into indexes, you're going to be setting yourself up for success in the future, in the long term. So keep dollar cost averaging, provided you have stable income, provided you taking care of things like debt, and you have proper savings and things like that, and you want to go into investment choices. Be consistent, start early, and do not panic. That's one thing you do not want to do, is let your emotions take over. You do not want to time the market. That's one thing that you do not want to do. So you don't want to say, I'm going to pull out now, I'm going to get in now. That's how people lose money every year. One way to set yourself up for success: start early, be consistent, and dollar cost average into proper indexes in the stock market or whatever investment channel you choose to do. So just be smart about it. Don't panic. Don't let fear get in the way. I just wanted this to be a quick little video just to go over the bonds, the yield curve, recession. What should you do? Like, a lot of people are freaking out right now. And it may be a self-fulfilling prophecy. I don't know. But we will have to see. I'm not concerned. I'm a long-term investor, and I'm looking towards the long term, as you should be doing too, unless you're a trader or you're just looking to the short term. In the short term, I'd probably go with like a CD or something. I don't know. I can't advise that. But if you're a long-term investor, that's what I would do.